It's Global Finance, Topic 16, Foreign Securities, Risk, and Expected Returns. Copyright Lou Gaddis. In this topic, we're going to look at the types of foreign securities, methods of, buying equities in foreign markets. We'll talk about the costs and benefits of foreign investing, and then we'll compute the expected return, or I should say holding period return, and risk of foreign securities. The benefits of holding foreign securities are kind of obvious. First of all, you can get a diversification benefit by holding a security whose returns aren't perfectly correlated with your domestic market. You can reduce the risk of your overall portfolio. Also, with exposure to emerging markets like China and other areas in Asia and Eastern Europe, you have the possibility of having much faster growth. But the risks of foreign investing are many. In addition to just exchange rate risk, which we'll cover a lot, there's just illiquidity of smaller markets, lack of information and transparency of public companies, reliance on foreign legal remedies in case some investment goes wrong. What remedies do you have as an American to, say, get compensated for something a foreign company has done? There's foreign taxes, and then there's overall political and economic risks of that area. When we talk about the returns of a security, we're just going to talk about a holding period return. That holding period is you buy a security at P0, the initial price. P1 will be the new price at the end of the period. P1 minus P0 is your capital gain, and then any dividend or interest payment will also go into the computation of holding period return. So here's a case of a holding period return from the perspective of a Japanese investor buying Sony stock. They buy the stock for 5,000 yen. It's selling for 5,500 yen in 1 year and also pays a dividend of 250 yen in 1 year. In this case, they get a 500 yen capital gain, 250 yen dividend payment, divide by our $5,000 investment, and you can see this Japanese investor got a 15% return on their Japanese stock. Now the question is, well, what would the return be if this were an American investor? What would be the US dollar return? Well, to know that, you need to know what the exchange rates were at the time of purchase and sale of the stock. So say when the stock was purchased, the exchange rate was 100 yen per dollar at the purchase price of 5,000 yen. And at the time of sale and receiving of the dividend, the exchange rate was 105. So we'll now compute the US dollar rate of return of this investment. My initial cash flow in dollar is a 5,000 yen cost times the dollar-yen exchange rate, 1/100. So the initial cost will be $50. And then at the end of the year, you'll get 5,500 yen plus 250 yen dividend payment, and we'll multiply times the new exchange rate of 105. So instead of multiplying times 1/105, I'll just divide this by 105. And you can see an American investor would have received $54.76. So our US dollar rate of return is going to be our 54.76 minus our initial cost of 50 over 50. So our US dollar return is 9.52%. So the Japanese investor receives 15% in yen, or for an American, it would be 9.5% return in dollars. And the difference is because the exchange rate. Over this period of time, the yen must have devalued, and we can look at that. We said the exchange rate went from 100 to 105. So we can look at the appreciation of the yen. Since this is an indirect quote, yen over dollar, and I want to know the appreciation of the yen, I will use 100 minus 105 over 105. That'll tell me what happened to the yen. And you can see the yen is down 4.76%. So the yen return of Sony was 15%. We said that the dollar return of Sony was 9.5%. And we know that the yen devalued 4.76%. There's a shorthand way of trying to compute a US dollar return given the appreciation of the currency and the return in the foreign currency. That's given by this equation here. The dollar return of a foreign investment is 1 plus the foreign return plus 1 plus the appreciation of the currency, where C is denoted as the appreciation of the foreign currency. So my dollar return is going to be the yen return times 1 plus the appreciation. That's a negative. And you can see that we can calculate directly that if we knew that we had a 15% return in yen, and then yen devalued 4.76%, we have a 9.5% return in US. An approximation for this formula, it would be just take the yen return, add in the appreciation of the currency, and that gets you about a 10% return, which is an approximation of what happened here. It was actually 9.5. So this formula here tells you how to compute the dollar return of a foreign investment directly from the foreign return in the local currency and the appreciation of the currency. Using that formula, we can answer another question. So you expect the Toyota to increase by 10% in yen. Inflation in the US and Japan are given. So here's our yen inflation. Here's our dollar inflation. So what's the expected return, US dollar return of Toyota? Well, you're given that the return is expected to be 10% in yen. So now I just need to compute the expected appreciation of the yen, the C. Well, using interest rate parity, I know that the expected appreciation of the yen is going to be the ratio of dollar over yen inflation, or interest rates, minus 1. There's my dollar inflation, yen inflation. And you can see the yen is expected to appreciate by 1.9048%. And we could make an approximation, right? You know here that Japan has 5% lower inflation, so I can just assume that they're roughly going to appreciate by about 2%. And if I take that 2% appreciation of the yen plus my 10% appreciation of the stock price in yen, I get about a 12% return in the security, which does give you the right answer, but let's do it more precisely. My dollar return is going to be the return in yen plus my yen appreciation. And that's how I solve that problem. So again, this formula allows you to think about the returns in dollar, the returns in the local currency, and also the relationship with the return of the currency or the appreciation of the currency. This next problem asks a slightly different question with that same formula. So we're still going to use our formula, dollar return 1 plus the foreign return times 1 plus the appreciation of the foreign currency minus 1. But in this case it says the US notes, Treasury notes, are yielding 2%. German Bunds, which are their Treasury notes, are yielding 3.5%. What's the appreciation of the euro to ensure the bonds have the same US dollar return? Well, I can approximate that. I can say that if a Bund gives me 3.5, what appreciation of the euro will make it give us the return of the US bond 2%? And you can see that it's approximately 1.5% negative. So if I get a 3.5% return in euro, and the euro depreciates by about 1.5%, that'll give me a 2% return in US. But we can solve this problem using the formula. My US dollar return is 2%. My return in euros from the Bund is 3.5. And then I can solve for C in this equation. And C turns out to be equal to negative 0.0145. So that's how we're going to calculate the holding period return of a foreign investment. Holding period return depends on both the local return and the return of the currency, or the appreciation of the currency. And that's the way to think about a foreign investment. A foreign investment is an equal investment in both the security, say the Bund or a share of Sony or a share of Toyota, and an equal investment in the currency. The return as an American depends on both. Now, to calculate the risk of a foreign investment, we're going to use standard deviation. So standard deviation is the standard measure for risk in finance. Gives us an idea of the dispersion around the mean. When we try to calculate the standard deviation for the variance of a foreign investment, it's a little more complicated though. The variance of a dollar return of a foreign investment, for example, the variance of the variance of the dollar returns of, saying, a share of Sony depends on the variance of Sony in yen, the variance of the exchange rate, plus 2 times the correlation between these two factors times the standard deviation of these two factors. And if this formula looks familiar from other investment classes, it's because it's almost the 2-asset portfolio formula. So if you remember from other classes, if you're looking for, say, the variance between holding stocks, say, A and B, you probably had a formula that looks something like this: the weight of A squared times sigma A squared plus the weight of B squared plus sigma B squared plus 2 times the correlation times the standard deviation of A and B times the weight of A times the weight of B. Well, this is the formula that we're using here, except in this case that the 2 assets are both the stock and the currency, and you're actually invested 100% in both. So if I put $50 into a share of Sony stock, I have a $50 investment in Sony and a $50 investment in the yen. So my weights turn out to be 100% invested in both. That's why these W's go away. And I get this formula here that looks like the 2-asset variance formula, where the W's are gone because the weights are 100% in both assets. So I can now calculate this problem. The standard deviation of Sony for a Japanese investor is 23%. So if they just look at the standard deviation of yen returns, and I know the standard deviation of the yen, let's say the dollar price of the yen changes, is 17%, and the correlation between these two factors is 0.31. I can calculate the standard deviation for an American holding Sony stock. So if I want standard deviation, I'll get rid of the square term, and I can just take my variance to the square root. So the standard deviation in dollars for Sony is going to be the square root of the variance of Sony's shares returns plus the variance of the exchange rate returns plus 2 times the correlation times the 2 standard deviations. In this problem, it turns out to be 32.6%. So what you see is holding a foreign security is generally riskier than holding a local security of similar business risk, because you have 2 sources of risk. You have the risk of the stock and the risk of the currency. So this will be our general formula for calculating the standard deviation of a foreign security in dollars, or the standard deviation of dollar returns of a foreign security. So the last thing we'll talk about is, well, say I want to buy a share of Sony, how do I buy it? Well, there's the hard way and there's an easier way. The hard way would be to, say, take $50, go to a bank, convert it into yen, have those yen deposited at a broker, have the broker buy shares on the Tokyo exchange, and then every day that the share would pay a dividend, it would be paid in yen. I can then have the bank convert the yen dividend back to dollars using the bid-ask spot prices. And then when I finally sell the stock, I can also convert the exchange or the cash flows into yen, from yen to dollar. So you can buy shares on foreign markets. But for an American, we can also buy an ADR. ADRs, or American Depository Receipts, are a system in which a bank buys a share of, say, Sony stock, or buys a bunch of shares of Sony stock, puts them in a portfolio, effectively, and then sells shares of that portfolio to Americans where the price is quoted as $1, and each share of the portfolio is really a share of Sony stock. You have level 1 ADRs, and you have level 2 and level 3 ADRs. Level 1 ADRs are a little riskier. They're not registered with the SEC. They're not GAAP compliant, so they are pretty speculative investment. Level 2 and level 3 ADRs are securities registered with the SEC and are GAAP compliant. So I can look at, say, a Sony ADR, and I can look at their financial statements knowing that they are GAAP compliant, and I can compare them with other U.S. securities. There are many advantages of ADRs, namely is everything's conducted in dollars. Dividends are paid in dollars, you pay a price in dollars, prices are quoted in dollars. You in fact never would see a yen quoted. Also, a bank is able to save investors on average between 10 and 40 basis points compared to doing the shares directly. So the banks have better access to exchange rates and the purchase of shares at a better price. However, ADRs do not reduce any of the exchange rate risk. Now, for example, let's take a look at the Sony ADR. So a Sony ADR is called SNE. Right, that's the stock symbol. It trades on the New York Stock Exchange, and you can see the price is $22.06. So I can call my broker and say, give me a share of SNE, and you'll be charged $22.06, assuming that's, say, the asking price of the stock. And if any dividends are paid, you'll receive those in dollars, and when you sell the stock, you'll receive dollars. All right, and what you can see is the SNE, the Sony ADR, was down, say, 40 basis points today. All right, what we don't know is if the reason that the stock is down is because the price of Sony in Tokyo is down in yen, or if the exchange rate, say the dollar price of the yen, is down 40 basis points. So those are two likely outcomes. It could be that the shares of Sony in Tokyo are unchanged, but the yen is devalued 40 basis points. Or it could be that the exchange rate has not changed, but the price of Sony has decreased by 40 basis points. So this just reaffirms the fact that the holding a ADR does not reduce any of the exchange rate risk. You just don't see it. You just see price changes. Those price changes are combinations of exchange rate changes and security changes in the foreign currency. There's also GDRs, kind of like ADRs. So GDRs are securities just like ADRs, but they are placed at institutions. So hopefully we learned exactly how to buy a foreign security, either at a foreign market or through an ADR. Talked about the costs and benefits of owning foreign securities, and talked about how to calculate a holding period return and standard deviation of a foreign security.